What's going on, YouTube? We are going to go through Intel Corporation, ticker symbol INTC. We've had a few people request for this company to be analyzed and valued. So that's what we're going to do. Over the course of 1 year, Intel is up about 10%. Year to date, Intel down about 36.6%. They reported their Q1 earnings April 25th. They beat on their EPS, but missed on revenue, slightly missed really. And we got a little bit of guidance from Intel as well. And with that guidance, we can see the EPS revisions in the last 90 days. There was 31 revisions and all 31 revisions down. We got revenue estimates though that are up quarter over quarter there. And we've got EPS estimates coming in less than where their previous estimate was even after they saw a beat. So overall, analysts aren't having very high hopes for this next quarter. So in their earnings call, there's a couple things I highlighted. There was, one of the big talks of Intel is their new foundry and obviously their overall financials as well. Their financials are terrible. And right here, this line specifically caught my attention. There's a couple lines here, a couple little sentences caught my attention. But Q1 operating cash flow was negative 1.2 billion, which we'll see once we get over the 10Q. Net CapEx was about $5 billion, which you add those two together, you're negative $6.2 billion free cash flow. All right, so you spent $6.2 billion. That's how much cash flowed out of the business, was $6.2 billion in 1 quarter. All right, and then on top of it, you paid out dividends of $500 million in the quarter as well. That makes absolutely no sense. Why to pay a dividend and on top of it lose $6.2 billion? Also, in Q1, they expect that to be the low point for adjusted free cash flows driven by seasonal factors, including timing of annual bonus payments. Okay, so they're blaming it on paying their executives too much money, which brought my attention to, let's see how much their executives make. Now we can see here's their salaries, based on the highest paid people over in Intel. And the CEO, $16.7 billion currently. So I wanted to compare as well to 2020 to see, what's the difference? Are they getting paid more today or are they getting paid less? And then we come down here. We can see they actually have pulled back on paying their executives. So that is a positive in this situation here. So even with them paying out some bonuses and whatnot, they're still paying their executives quite a bit less than where they have been in the past. So that's a good thing to see. So we come over here to our financial spreadsheet. And we are going to come over here to the charts and compare how this company has performed financially. So we got revenue, gross profit, and net income. And we can see the overall trend is significantly lower as of lately. And you can compare your revenue here, this blue line. Currently, we're sitting at 2015 levels in revenue. And then we come down here to net income, or actually come over here to net income. And in trailing 12 months, comparing to 2015, we're about 2 to 3 times less today in net income than we were in 2015. So that kind of tells you that this company has not performed very well over the last 9 years. Gross margins, you can see the trend of margins went from 62.6 all the way down to 41%. Net margins, call it 20%, down to negative 3% in the most recent quarter, or trailing 12 months down to 7.4%. Then we come down here, return on invested capital. In the past, they've done pretty decent return on invested capital. Usually you like to see about 15 or more. 10 to 15 or more, and they've done a pretty good job of being in that range, but they have not been in that range in many years now. You got PE ratio, historically 10 to 15 range, mid to low teens is where they seem to hit on a PE ratio. Today, they're currently at a 33 PE. That could give you a pretty good indication that they are significantly overvalued right now. Cash to short-term debt. So in their cash position to short-term debt is not terrible. Usually you like to see at least enough cash to cover short-term debts. That makes you have a relatively decent balance sheet. And we can see back in 2015, I would consider that a pretty good balance sheet. Today, we can see we are below our current debts, which gives you an indication that balance sheet is not as strong. Then we got cash to total debt. We can see our cash position in the blue bars here hovers around $25 billion and currently declining as the last couple of years. And our debts just continue to climb year over year. As our debts climb, our cash shrinks. Not ideal. Then we go over here to net income to free cash flow. We can see that, again, charts, everything just turning negative on this business right now. And our net incomes, we know as of lately, are turning negative. Trailing 12 months, though, positive, but our free cash flows are getting hit hard as of lately. Then we come over here, we can take a peek at free cash flows on their own. Negative 14 to $12 billion in free cash flow on an annual basis is crazy. $13 billion negative free cash flow trailing 12 months. Capital expenditures, though, we can take a look at these. These things are also just exploding. In 2015, $7.5 billion in capital expenditures. That sounds like a lot in itself. And today, $24.3 billion in capital expenditures that they spend annually. Share count dilution. They have in the past bought back shares. Today, they are issuing more shares than they are buying back. Probably a lot of that stock-based comp. They're probably not actually issuing shares. They could be issuing shares. They are issuing stock. Actually, if you come up here, we can see common stock issued. They are diluting shareholders. Common stock, they have bought back a little bit of shares recent years here, but overall, they are actually diluting you as a shareholder if you hold this. Dividend, they had dividend growth and since have cut it down, I believe, at least in half. And to be fair, I think they should completely eliminate their dividend. So overall, as what we can see, this just is not a very attractive financially ran business at the current time. It's not to say they can't turn things around, but right now, financially, this looks very bad. Then we can come over here to their 10Q. We're going to start off with the income statement. This is 3 months ended. This is over the year-over-year comparison. And we've got revenue growth about $1 billion, which is about 8%. Gross margins is up about 23%. We come down here to operating expenses, which are also up about 13%. And because of operating expenses, we are now left with a negative net income. So it costed them, between their cost of sales and their operating expenses, costed them more than what they made. Then we come down a little bit further into their 10Q, and they've got a little bit more of a breakdown of each segment of the business here. And one of the biggest things has been their foundry. Their foundry has been what is leading the speculative motivator in this stock, in the share price in the last, probably year maybe. And we can see here's our Intel foundry, their newest, I believe, addition to their business, if I'm not mistaken. And we can see that it did about $4.8 billion this time last year. A year-over-year comparison, their Intel foundry business in revenue is down by $500 million. So this new foundry business that they've got going on is not even making more money year over year. It is actually shrinking and hurting this business and costing them a lot of money. Overall, the Intel foundry costed them $2.4 billion. So they didn't even make money on their foundry yet. They're losing more money year over year, $2.4 billion that they're losing on this business. And this is in 3 months, or this isn't even annualized. So in an annual basis, that's about $10 billion they're losing on their foundry business currently. So down to their balance sheet, they are sitting on about $21 billion in cash this time last year. Actually, 3 months ago, they were sitting on $25 billion in cash. So they've got plenty of cash. They've got lots of cash. But once we get to the free cash flows, you'll see that's not a lot of cash. That cash won't last them very long at the current rate. But nonetheless, $21 billion in current cash. We come down here to our liabilities. They're sitting on about $27 billion in total current liabilities. So $21 billion in cash minus $27 billion in current liabilities. And you add on top of it negative income. That is just not a very good situation to be in, not a very strong financial business at all. When you're not making money, you're losing money on top of it, and you don't have enough cash to cover your current liabilities. That is a recipe for disaster. Then come over to our cash flows, see how the cash flowed in and out of the business. And we've got our net income loss in the last 3 months up here. And we can see stock-based compensation continues to tick up year over year. Now they're at paying out $1.2 billion in stock-based compensation. Not millions, billion. $1.2 billion paid out in stock-based compensation. And even adding in stock-based compensation, there's still negative net cash provided by operating activities of $1.2 billion, which is right here. And then you have to add in your $6 billion loss of capital expenditures. And then that leaves you with negative $7.2 billion in free cash flow in Q1. This time last year, it was about $9.3 billion, so it's getting better. But even at a negative $7.2 billion in free cash flow, then you come back up to your balance sheet, you got $21 billion in cash, and you're burning $7 billion in a quarter. You have 3 quarters left before you're out of cash, before you have to raise more cash. So this company is burning cash way too quickly, and there's no signs right now that they're going to start increasing their revenues anytime soon to cover these negative free cash flows. So definitely really concerning financially over at Intel, at least what we're seeing right now. The trend is not in a good direction. So they also had an issuance of long-term debt of $2.5 billion this most recent quarter. This time last year, they borrowed $11 billion. And then they also are still continuing to pay out a dividend, even with negative net income and with free cash flow negative of $7.2 billion. You're still deciding to pay a dividend, even though $529 million isn't going to make much of a difference in a $7.2 billion negative hit. Obviously, that's not including in your free cash flows, but you add $500 million to an already negative free cash flow, you cannot afford to pay your dividend. So would likely see a dividend, it'd be a positive if you saw dividends get eliminated, dividend payouts eliminated for the short term, at least on this business, because they just cannot afford it. All right, so now over to the comps. I pulled up 3 other companies to compare it to. We have IBM, NVIDIA, and AMD for comparables. Then we come down here to the overall charts and take a peek at margins and revenues and see which business is the one that is most attractive. So I come down here and we got our charts. Here's our market cap. We know NVIDIA's got a ridiculous market cap. And we come down here a little bit further. Here's our revenues. We got revenue, gross profit, and income. And we can see NVIDIA does fantastic. IBM kind of doesn't do that great either. You can kind of see IBM and Intel seem to be in the similar trend of margins. And then you have AMD over here, which is kind of just squeaking by and getting positive into its overall margins as well. And we got growth rates. Intel's got some decent growth ahead of it if it can do it, and you got AMD over here also has some pretty significant growth forecasted. Then we come down to our margins. We got 41.5% gross margin, lowest one on the board. Operating margin 1.3%, also lowest one on the board. Profit margin 7.3%. Not the lowest. AMD is actually the lowest on profit margin. And then we got free cash flows, negative free cash flows. We already know that. And the other 3 comparables are positive free cash flows currently. Return on invested capital, NVIDIA, obviously we know NVIDIA. NVIDIA is just a beast, and nobody can really touch it, at least at this current time. And then we got a PE ratio on the board here. IBM actually showing a lower PE ratio than Intel. So IBM could potentially be a better buy, even though it's near all-time highs. IBM could potentially be that better buy over Intel just based on a PE ratio. Over to the calculator to figure out what Intel is worth. We are showing a 22% EPS growth rate on Intel over the course of the next 3 years. That gives us a Peter Lynch fair value of about $20.75 per share. We have a multiples comparison here between the 3 companies we are comparing to. However, we can see AMD has a current PE of about 240. So because that's kind of really going to throw off a valuation so much, we're going to not include AMD in our multiples comparison. And you can see how much of a hit that just put on the price tag. That puts us at $45.90 per share. Then we got price to book. 5-year average is pretty much in line with current. PEG ratio, forward-looking PEG though, it's giving us a 1.66, which could tell us that forward-looking basis, Intel could be close to undervalued. It is roughly fairly valued right now. Graham's valuation, $41.29. Dividend discount model, $31.38 per share. DCF valuation, we know Intel is currently negative free cash flow, so we cannot use discounted cash flow based on today's numbers. Rule 72, we have three sources of an EPS growth rate, which are all over the board. But that gives us an average about 21.6 EPS growth rate, which we get to then double our current EPS 3 times. And that gives us about a 7.6 for a future EPS, which gives us a fair value of $82.11. Adding up all of our valuation methods here, that gives us a fair market value today of $44.29, basically trading at our 30% margin of safety at $31 per share. Analysts have a price target on this one of $40.26 per share. So you can see we are basically in line with analysts, and currently the stock is trading at about a 30% margin of safety. So now top over to the stock chart. And to be honest, there's nothing really too attractive here to draw. There's no, typically I like to draw trend lines and find good areas to pick up stocks and wait for opportunities. And I have 3 different lines drawn in here, and none of these lines really give me confidence that this is where this thing could be headed. And this blue line is probably the best line in here. This yellow line, you can tell there's probably some support in this $16 range. There's maybe some more resistance or support in this case in this 24 range. Maybe you can move it up here to like 28. That seems like actually it might be a better spot, about $28 per share roughly for a next level support. That's this one's tough because on a technical basis here, this might be a decent buying opportunity range. But on a financial basis, this thing is ugly. And if they cannot turn things around like in the next quarter or two, I think this thing has legs to come back down to $16 per share. I believe that, because if they can't turn things around, their financials, they need to get better. They have to get better if they want to survive. You can only stay afloat for so long before you're so heavily in debt that you just got to file for bankruptcy, and then that's it. That's what that's where, honestly, that's where it looks like this company is kind of headed. I hope they can turn things around, but based on their financials and the way they've been trending over the last many years, it's not looking very good. So that's kind of what I have for Intel. If you found value in this video, drop a like, subscribe, comment back later with another stock analysis video.